Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry.
A hedge that delivers convex returns during a market panic but carries positively is about as elusive as our lawmakers coming together in bipartisan fashion. As head of option strategies at AQR, Roni Israelov not only confirmed this, but saw in the empirical data distinctly unpromising results for hedging strategies that utilize put options. Trained with a PhD in financial economics from Carnegie Mellon, Roni has spent his career researching complex topics in markets. We explore his paper, Pathetic Protection, and the challenges that arise from paying option premium to reduce risk. Roni cites the path dependency of options as introducing sometimes significant variability in the effectiveness of a program. He also cites the equity risk premium and the vol risk premium as headwinds for success. Our conversation shifts to another interesting topic, rebalance timing luck, work that Roni has done in collaboration with newfound research. The finding that the performance of mechanically rebalanced strategies can rest heavily on the date of rebalance is especially the case for option strategies like the giant put spread collar on the S&P that is rolled each quarter. Roni is now the president and CIO of Endeavor, a firm providing optimized portfolio solutions to individuals using academic research, technology, and tax efficiency. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Roni Israelov.
My guest today on the Alpha Exchange is Roni Israelov. He is the president and chief investment officer of Endeavor, a wealth management firm that's delivering optimized portfolios to its clients with a healthy benefit of academic research and technology behind it. Roni, it's great to have you on the podcast today.
It's great to be on. Thanks, Dean, for having me. I'm excited to have a lively discussion.
Me too. I had come across some of your work years ago and really got me thinking. You had done some work, which we're going to talk about extensively, on some back-tested results around protective put strategies and the degree to which they are very challenging to consistently monetize. So that'll be one of the topics of conversation that we'll dive into. So, Roni, you've got a great background here. You spent a number of years at AQR, which of course is a large money management firm, but also an academic think tank in a lot of ways. So tell us about your career history, how you got into the business of finance. It seems an outgrowth of some of your academic research in a PhD program, but just tell us a little bit about your career history.
Yeah, so I've always had an interest in finance, but it wasn't until I found my way into a PhD program that I was able to actually pursue it more rigorously. So I went to Carnegie Mellon and completed my PhD in financial economics in 2007, in early 2007. And my thesis was including 3 different papers, one on liquidity, one on liquidity risk, and then I had a third paper, which was a theoretical econometrics paper. So that made for hopefully a well-rounded dissertation. And I left Carnegie Mellon early 2007 and joined Lehman Brothers. I joined a quantitative equity strategies team. So we were a sell-side team focused on stock selection strategies with a quantitative lens. We were researching long-short strategies, long-only strategies, US-based, global, and relaxed constraint strategies, which for those who aren't familiar with that, that would be a 130-30 strategy where you would be long 130% notional and short 30% with a goal of having a beta of 1. So I was at Lehman for about a year and a half, and I left in September 2008, just before Lehman collapsed, and that took me to AQR. I spent a little over a decade at AQR. When I joined the global asset allocation team, and I was overseeing equity country selection strategies. So developed in emerging markets, but equity index country selection strategies. And from that vantage point, I had the opportunity to work on a number of different elements of portfolio construction. I was focused on factor research. I was focused on risk modeling. I was focused on portfolio construction. And it really gave me the opportunity to see many different areas and contribute to many different components of portfolio construction within that strategy group. After spending some time on the equity country selection and risk modeling, I was given the opportunity to launch and manage a futures stat arb strategy. So a firm as large as AQR in terms of the assets under management, most of their strategies tend to be longer term in nature, higher capacity strategies, but we were looking to develop some higher sharp, lower capacity strategies. And I had the opportunity to spend a few years focused on building out that initiative. And then an opportunity arose for me to oversee the options team, the vol strategies team. And that's basically what I spent the last 5 or 6 years of my time at AQR working on. When I took over the team, it was primarily focused on hedge fund options oriented strategies, so relative value, long, short. But I saw an opportunity to build out an initiative that was focused on volatility risk premium harvesting. So we ended up expanding the scope of the team's work and launched and managed a number of volatility risk premium oriented strategies. And then for the last year and change of my time at AQR, while I was overseeing option strategies, I was given the opportunity to oversee the portfolio implementation research efforts for stock selection. So I basically came full circle. I was working on stock selection strategies at Lehman Brothers, and then for my last year and change at AQR, I had the opportunity to come back and think about stock selection from a portfolio construction point of view. That took me to about January 2020, and that is when I left AQR to join Endeavor as the chief investment officer and president. And as you said, we're a wealth management firm. We call ourselves a wealth optimization firm. We serve affluent and high net worth individuals and families. And we specialize in creating and managing custom lifestyle protected growth portfolios, which are designed to optimize the balance of providing cash flow security while targeting portfolio growth. So these are very hyper-customized portfolios that are developed for each client's individual plans and goals.
Well, that'll give us a lot to circle back on in terms of the here and now of what you're working on. Let me just make one observation. So as you left Lehman Brothers in September of 2008 and then left AQR in January of 2020, well, 2 to 3 months later, the VIX was at 80 in both circumstances. So I'm not sure, Roni, you've got some degree of timing. I know some of your work is on rebalancing luck. So maybe there's some relationship there.
Yes, it was a funny set of circumstances, especially the vol spike that occurred alongside COVID. That was an important event in our industry.
For sure. Well, let's go back. You said something about your work at the PhD program that really had me interested, and that was this work on liquidity. There's certainly some relationship between market volatility and market liquidity. And right around that time you were working on that PhD dissertation, markets in a lot of ways were as low vol and as highly liquid as possible. You know, when we think about the Black-Scholes framework, or certainly any theoretical framework in finance, there is just this notion that markets are complete. I like to say it's a your size is my size assumption that, you know, whatever you want to do, whatever time of day, in whatever size, the market's there for you. And of course, there was some version of that in the period of 2005 and 2006. Markets were incredibly liquid. There were giant trades going through, for example, the credit default swap market that, of course, ultimately went awry, ran amok. Tell us a little bit more about the empirical side of the research you did on liquidity for your dissertation.
Yeah, so as I said, I had 2 papers. One was on the pricing of liquidity risk, and then the other one was an event study looking at a liquidity event that took place in Japan. So on the pricing of liquidity risk, the basic idea was to view liquidity as a stream of liquidity events, essentially. So if you're buying, and I was focused on stocks in this research, but if you're buying a stock, it's not only important what the contemporaneous liquidity properties are, but it's also important what the future liquidity properties are. And if you learn something about a stock becoming more liquid or less liquid, that knowledge about the future stream of liquidity cost associated with trading it should impact its current prices. And essentially, I was fitting a model that was taking into account the liquidity dynamics over time. And that seemed to give an improvement in fitting a liquidity adjusted. It was the more when incorporating future liquidity risk into the equation. And then the other paper, it was kind of a fun little paper. There was an event in Japan where, due to fraud, a single company, LiveDoor, there was an incredible amount of trading that took place when that fraud was announced or understood to be the case. And the amount of trading that took place, it was only a doubling in the trading volume versus historical norms. But that was enough to effectively overwhelm the computer systems, the trading systems on the Tokyo Stock Exchange. And within, I think, like an hour or so of markets opening on that day, the entire market shut down. Nothing could trade because the computer systems were overwhelmed. And they announced that it would take them 6 months to a year to upgrade their systems. So it was this shock to the market where participants learned that if they needed to trade, if they wanted to trade and there was incredible demand for trading, they would be unable to, that the actual systems would fail. And I was looking at that as an event study to understand how different stocks were impacted by that news. And what was interesting was it was the more liquid stocks that seemed to be impacted more. And I think we see this in many different areas, that oftentimes when an illiquidity event takes place, or when a liquidity event takes place, sometimes it's the liquid stocks that react more because they're the easier ones to sell. One example might actually be investment grade credit during COVID and other periods, where that is an easier asset for institutions to liquidate, so their prices end up being more impacted by those types of events.
It's a really interesting observation. And certainly during that darkest week in the COVID market crisis, I would say, let's call it mid-March, I think the S&P had 3 straight 9% moves, but the Treasury bond complex got taken down along with it. The riskless asset became a source of liquidation because people just needed the capital. It wasn't enough to call it risk-free. You actually needed to convert it to cash in a hurry. That's really interesting. And as you think about the theoretical world of markets and how market prices are set, perhaps looking back at some of your work in the PhD program versus what you've observed in actual market events. So we talked a little bit about COVID. We touched on the GFC. Are there any just big picture observations that you can share around how these things sometimes get disconnected, this world of infinite liquidity, of complete and perfect markets versus the reality that sometimes there's just no price that is capable of coaxing a seller or a buyer into a transaction?
Yeah, I mean, I think the notion of complete markets, when we're thinking about pricing assets, it's convenient. It helps you develop a model that you can use to determine theoretical prices. But I don't know that it really reflects the reality of markets. And when you look at risk premia that may exist, if you look at how one set of assets may be potentially dislocated from another set of complementary assets, assets that have similar risk exposures, I think it's largely because, in fact, these markets aren't complete and flows matter. And people's willingness to take on positions for whatever reason, or unwillingness to take on positions for whatever reason, also impacts prices and returns. And I find that to actually be one of the more interesting elements of understanding expected returns across different types of assets.
That pre-GFC period was so interesting in the way in which the size of the system got larger and larger and larger. And in some sense, that 9 VIX that printed in late 06 actually happened again in early 07 was a function, I think, of just this vast competition to sell vol, whether it's through CDS, whether it's through equity vol itself. But there was this downward pressure through the competitive forces to earn some incremental carry in a world where you hadn't been burned in years for being short vol. And so this is where I'd love to start our conversation on some of your academic work that has got a strong empirical focus in it. And that's on this notion of the vol risk premium. So you mentioned your time at AQR and overseeing that business. So why don't we start to talk about some of your work in this area? And as I mentioned, I had read one of your papers. It was called Pathetic Protection, which I thought was a provocative term. And as someone that has spent a long time in the options market as well, it's no doubt the case that there is this observable premium of implied volatility to realized volatility. And I think it begs the question of why and then what to do about it. So why don't you set the stage for us here? What got you interested in this notion of the vol risk premium? And then we can start to talk about some of your work and your results in studying it.
Sure. So interestingly enough, the way I got to vol risk premium was actually attempting to come at it from the other side. So as we were talking to some of our clients, and I was talking to client representatives at AQR, it was pretty clear that there would be interest in a long vol tail hedging product that had flat to positive carry if one could be developed. And of course, that's the holy grail, right? I mean, that's what everybody would look for, a positive carry tail hedge. And we ended up spending a considerable amount of time researching different option strategies in an attempt to find that. And it was hard. It was really, really hard. And the harder it was to try to find opportunities to be long vol in different constructs without the negative carry that it typically exhibits, the greater my conviction started to develop on the other side, that this volatility risk premium appears to be a very robust element of options markets. And in this research, we were looking quite broadly across option markets, across different equity indices, across different asset classes, not just equities, but bonds and commodities and FX. And just everywhere you look, options on average tend to be expensive relative to an actuarial fair value. So this idea that implied vol is high relative to realized vol, or the returns that you earn when buying options are negative, that was just a very robust finding. So that's what kind of turned me on, if you will, to the volatility risk premium side. And then I also, as I was working through some of that research, I became interested in writing a little bit about the protection side. That's how this paper came to be. And for those who haven't seen the paper, there are really two elements to the paper. One is trying to describe the impact that the volatility risk premium within these options has on the efficacy of protection. And to that end, the approach that I took was essentially comparing a protected portfolio, and I relied on the standard benchmark strategy. So this would be S&P 500 coupled with a monthly 5% out of the money put option. So I compared the properties of that to what I called a divested portfolio, something that instead of buying protection, purchased a certain amount of S&P 500 and kept the remainder in cash. And I solved for the equity portfolio that matched the returns of the protected strategy. So if you make it an apples to apples comparison where these two portfolios have the same compound annual growth rate, what is the difference in their drawdown characteristics? Because to my mind, the goal of protection is to reduce, well, one of the goals of protections is to reduce peak to trough drawdowns. And when I ran that analysis as a horse race, it just wasn't even close. The divested strategy slaughtered the put protection strategy in terms of having similar returns, but with materially attenuated peak to trough drawdowns. So that was part one of the paper. I was curious to what extent that was driven by the vol risk premium versus another property of put protection. So when you buy an option, and I think those that spend a lot of time in the option space understand this, but options are pretty complex instruments. They have a number of different exposures, and those exposures themselves have complex dynamics. So an option has delta, and the delta varies over time, and it varies as a function of the index level itself. It has exposure to changes in implied volatility and exposure to realized volatility. So these options are pretty complex, and those dynamics have an important impact on the efficacy of that option to deliver tail protection. So even when I looked at a hypothetical set of options that through a simulation environment that was designed to eliminate the volatility risk premium, what I found was that the peak to trough drawdowns of the protected portfolio were basically in line with the peak to trough drawdowns of just a divested portfolio that has the same average return. So even if you eliminate the volatility risk premium from options, it just didn't appear to be the case that buying put options for protection was helpful in terms of reducing peak to trough drawdowns. But I should add to that there are benefits that options provide outside of eliminating or reducing peak to trough drawdowns. One benefit is for those individuals or institutions who care for one reason or another about a very specific period in which they want to protect their portfolio. If they can align the option holding period with that period that they care about, then it's actually quite effective at protecting their portfolio. So as an example, if there's a reason why an investor wants to protect their portfolio over a calendar month or a quarter, and they buy protection that is aligned with that, such that it expires at the end of the month or at the end of the quarter, that protection is quite effective. It may be costly, it may have negative carry associated with it, but it does effectively control the size of the crash. Another benefit provided by options is crash protection. So if someone is concerned about a sudden and extreme crash, S&P collapsing by 30 or 40%, then buying protection can help control or limit the magnitude of the downside exposure to that crash. There are still benefits, though, to having more control over the options selected. And I think this is, in a way, something that these 1 day to expiration and 0 day to expiration options help with, is that they allow people to protect their portfolios against crashes on very specific events, macro announcements or whatever, in a way that trading monthly options or quarterly options do a less good job of.
Yeah, there's a lot there. And I think the base result of observing that over time, the buyer of a put option is up against two things. One, the vol risk premium, and the second one, which you talk about as well, is the equity risk premium. You're reducing the delta of your portfolio, and that itself over time, at least in the 100 or so years of history we have, that has also been costly. So in addition to the vol risk premium, there's the equity risk premium. I think that when I look at the reasons that folks use options, and let's just call it from the long side. So there's certainly an observation that you're fighting the vol risk premium. I think that there is a view that, and maybe this is the tail outcome that you're pointing to, that when markets truly become unhinged and are just falling several percent each day, the VIX is into the 40s, 50s, and sometimes 70s and 80s. Rare, but it has happened before. One, that's the time where investing, putting new money to work has proven to be the most valuable, but it's also the most impossible, right? When you're nursing giant mark-to-market losses on the decisions you've already made, even as you want to put fresh capital to work, it's impossible to do because you're defending the poor decisions you've already made. And so when I hear people talk about the benefits of owning optionality, it's to be a considerably more empowered buyer in the depths of giant sell-off, where everybody else is trying to cover risk, buy back vol. If you own it already at a low price, and again, it's all about the price that you get it at, you can find yourself in a much more empowered position to put fresh money to work. That doesn't push back against your results. It's just to sort of discuss the philosophy of folks who do position options as a, what if this happens? Let me put myself in a better position to put fresh money to work in a very difficult environment.
I think that's one of the motivations, and it's a powerful motivation. I mean, I understand the desire to have these types of tail protection in place. And I'll just back up and just to complement something that you had said in terms of the put options impact on equity risk premium and vol risk premium. So in my analysis, what I saw, and of course this depends on any given implementation, but if you're buying the 5% out of the monthly put option, you see roughly a 25% reduction in equity exposure in beta. That's certainly going to have drag. You're giving up a quarter of the equity risk premium. And in the sample that I look at, the volatility risk premium impact is about negative 1.8% annualized. So That's what you can imagine the carry is of that put option is a quarter of the equity risk premium plus another almost 2% drag on performance. And then if I step forward and go back to the motivation of having something that pays off and gives you dry powder that you can potentially allocate in these times of stress where, markets are a little bit more dislocated, that's a strong motivation. The concern or risk that I would bring about is that the way these tail protection strategies tend to work is most of the time when markets are not stressed, you're contending with negative carry. So I think most people would understand that they are going to see some amount of drag on performance due to the two factors we just talked about during good times. And then there is an expectation or a hope, or maybe a necessity, that the strategy pays off in bad times. And I think the risk that I highlight in that paper, and then I further highlight in a follow-up paper that I recently wrote with a colleague at Endeavor, is that you might not get that payout that you're hoping for when you need it. And that is concerning.
Yeah, that's really interesting. And you mentioned options are complicated. The 25 delta put with certain gamma and vega characteristics that you purchase as protection becomes something entirely different. It more likely than not fades away to zero in terms of its Greek exposure and probably its premium, if that equity risk premium is correct and the time decay kind of overwhelms the put. It could also go the other way. It could become a very in the money put option where suddenly your notional exposure has gone up a ton, even as your vol exposure has gone down. So then you wind up sitting with something on your sheets that, again, it could work out for you or against you, but it's becomes markedly different in its risk characteristics than when you initially put it on. I wanted to ask you this, and this is about the vol risk premium, but also the characteristics of short vol exposure, and that would be negative skewness. If I think about the distribution of returns just for, let's say, some ownership position in the S&P 500, we do have a single day when the S&P fell 20%. We have no equivalent up day. We have one or two up days of 10 plus percent. They always occur during crisis periods. But by and large, there's a negative skew to the index itself. Short vol positions, I think you'll agree, have a decidedly negative skew profile to it. So there's sort of some swapping of that vol risk premium that you enjoy, but being short can be nasty. Just ask long-term capital management as one example. Talk to us about the profile of a hedged S&P position versus a non-hedged position in terms of the skewness of the returns.
I think that's an important point, and something I would emphasize is that portfolio construction, if you're seeking to implement a volatility risk premium strategy or a hedging strategy, is very important. And understanding that markets can crash by 20% in a day, we've seen it, I think is important in trying to understand the risk profile of such a strategy. I have a paper with the former colleague at AQR, Harshit Tumala, that was called Which Index Options Should You Sell? And in this paper, we specifically look at the return properties of S&P 500 index options across the surface, across maturities and across strikes. And we look at the average realized returns. But then in terms of risk, we focused specifically on the risk that would arise from a large crash. And we ran essentially stress tests where S&P 500 was down 20% and implied volatility would spike by a certain amount depending on the maturity of the options, a meaningful spike in implied volatility to stress these options, much in the way that an FCM or a prime broker would stress it and determine their own margin requirements. And I think it's important if you're implementing such a strategy to understand that that type of risk can occur. It's not likely, but it certainly can happen. And the way the positions are sized should be cognizant of that risk profile. I think a strategy should have a sense of a risk budget and a loss profile that is deemed acceptable in such events.
So, of course, this year, all the rage is the zero DTE option. 25 years ago, when LTCM had built up its giant position in equity volatility on the short side, those were 5-year options, right? So very different profiles of risk, one more gamma, the other considerably more vega, lots of ways to make or lose money in both of those. In terms of the vol risk premium, one of the things you said got me thinking about this question, which is if there is this persistence to it, and you think that with a systematic strategy, there's no free money in markets, you got to take risks, so you can get banged up on this stuff on the short side. But over time, it's demonstrable enough that you think you can play a role in harvesting that vol risk premium. My question is just around, does it become an all the time trade? In other words, almost to the question around factors, which AQR has contributed a lot to. Time variation of the value factor, as an example. Do you just stay with it all the time? Are there times when you think that the opportunity set, let's say in a factor, is been diminished by the price of that factor, or vice versa? It's more compelling because that factor has been beaten down. My question is on the vol risk premium side. Would there be a time where you look at it and say, gosh, they've got the VIX here at, 8, and realize vol is at 10? Boy, I just don't think that trying to harvest this vol risk premium makes a lot of sense right now. So I'm going to pull back my allocation to it, or vice versa, where something on the short vol side seems especially compelling and you want to get larger in it. How does someone with a quant background like yourself think about that question?
So what I would say is I think the vol risk premium is strong enough and pervasive enough to where if someone wants exposure to it and they don't believe that they can be tactical, I think they should still, assuming a well done portfolio construction, I think they should still have some comfort in allocating to a passive volatility risk premium strategy. That said, I also think that it is possible to be tactical successfully with volatility risk premium. And if I go back to where I started in this idea that I found it very difficult to construct a positive carry long vol strategy, if you look at these options tactically, you do find predictability in returns. There are some periods where the returns look stronger, and there are other periods where they look weaker, and there are few periods, not many, where they look negative. And by negative, I mean if you sell the options, you'd expect to lose money instead of make money. I think the opportunity that presents from that is if you have that view and if you have conviction in that view, then arguably it would not make sense to allocate or sell options to harvest the volatility risk premium if you think the expected return to that is negative or even zero. You're introducing undesirable left tail risk to the portfolio. It can make sense to do so, but only if you're appropriately compensated for that risk. And if you have reason to believe you're not appropriately compensated for that risk, I would not think that it would make sense to include that exposure. Now, the question is, what about when you think the volatility risk premium is especially attractive? Do you double down on it? I think that's a little bit harder given the fact that surprises can happen at any time, right? I think when a model predicts that the volatility risk premium is either strong or weak, it's not predicting that there's a greater or less great probability of a 20% crash. I think that would be very difficult to predict. It's predicting something more about the day-to-day carry of the strategy. So I think if someone is allocating to the strategy, they have to understand that by doing so, they are exposed to crashes, and they should not have any presumption that they can time their way away from having that crash exposure. That being said, there are times when it's more or less attractive to put that risk in your book.
It's such an interesting thing to look back on these big giant vol events, and hindsight is more than 2020. It's easy to see, at least in your mind, that, oh, wow, this would have been a great time to step in. That being said, it is the case that the timing of the peak in vol is typically the same timing from a regulatory standpoint or a central bank standpoint or a public capital standpoint, where there's no mas. We have to put this to bed. The banking system is at risk. The economy is at huge risk. And so you sort of shake hands with the Fed and say, look, I'm going to go your way. You're trying to put an end to this. And your express goal is for the VIX to go from 70 down to 30. That's job number one. That was the financial crisis. And so in some ways, you can kind of free ride off the public capital that comes to the rescue. I wanted to ask you one more question on VRP, and then I'd love to talk about some of your really interesting work on rebalance timing luck And on the VRP, you kind of alluded to this. You said the VRP is pervasive across asset classes. My question is around a program where you're trying to capitalize on the VRP. Is it the sort of thing where you allocate almost on an equal weighted basis across different asset classes? How should we think about diversification of short vol?
So there is some diversification. I mean, within an asset class, there's some correlation, and you should plan for the potential for correlation, right? If you look historically, it's interesting that although the crashes seem to occur simultaneously across markets, the magnitude of the crashes can be quite different. So you might see 8% or 10% crash in one market and a 5% crash in another. And although you're losing in both, when you have a convex exposure like short vol, there is some diversification benefit to the fact that the magnitude of the returns aren't the same everywhere. At the same time, I think the prudent thing to do when you're building a volatility risk premium portfolio and diversifying across assets and asset classes is to sort of assume the worst and that these crashes happen simultaneously, at least within asset class. You may relax that assumption perhaps a little bit across asset classes, but you could have an equity crash and a simultaneous bond rally. And from a short vol perspective, both of those are bad. It's not the same as owning equities and owning bonds where one offsets the other. So I think the prudent approach is to assume that there are correlated crashes in these markets.
Yeah, I had done some work on this a couple of years ago, and the results were not really surprising. I found that equity vol and credit vol tended to be next to each other closest. Rates, a little different, as you noted. Rates and FX were a little closer to each other. Commodities was kind of a little bit more on its own island. So there's certainly some notion that a rising tide of vol lifts all boats, but not always. So there is some diversification, but probably more prudent, as you said, to just kind of assume the worst. Let's talk about the work on rebalancing luck. And I'll just set the stage. There is this gargantuan put spread collar on the S&P that gets rolled at the end of each quarter. For a new quarter, it's a very, very sizable trade. The investor buys a 95.80 put spread and then sells a zero cost call against it, a call that reduces the overall trade to premium neutral. And that trade gets a lot of analysis. And of course, there's a lot of AUM behind it. And that was one of the things that you studied in your paper. So talk us through this work. What got you looking at this and some of the prominent results?
Yeah, and one quick comment I'd make just on the put spread collar strategy itself that's interesting to me is that you have, as you said, the large fund that trades the put spread collar. And then there are other variations of this with different maturities. And another name that's often given for this strategy is buffered protection. And it's interesting to me with that type of name or description, it gives the impression that this is a protection strategy. And I think what motivates it in the case of the put spread collar is there is this region where if equities are down between 5% and 20%, you are unexposed. But what's interesting to me, and this isn't super related to the rebalance timing luck idea itself, but what's interesting to me is that this is in fact a short volatility strategy. It's not a long volatility strategy. So when people are thinking about implementing an equity hedge or a protection strategy, I do wonder if a short volatility strategy is the way to effectively protect one's downside risk. So that's just an aside that I would point out. What motivated this was a collaboration between Endeavor and Newfound Research. There are 4 authors on the paper. So myself, David Ndong from Endeavor, Corey Hofstein, and Stephen Braun from Newfound Research. And for those who are familiar with Corey, he has done a lot of work on rebalance timing luck in other asset classes. And he and I had spoken a few times over the past couple of years about the fact that options are really subject to rebalance timing luck. And this is really related to the pathetic protection paper, that a lot of the reason that the protection cannot be relied upon is because of the variability in outcomes depending on when you end up buying the protection versus when the event happens. So we thought it would be an interesting collaboration to explore the magnitude of rebalance timing luck in this very popular strategy, the put spread collar. And what we found is it's surprisingly important. Just to give a couple of numbers for the listeners here, but if you look at the three different tranches that can exist, so if you have a quarterly put spread collar, you have one tranche tied to a December rebalance, one tied to a January, and one tied to a February. And if you look across those over the history of data that we have, if you look at the best performing tranche versus the worst performing tranche, there's about 1% annualized return difference between them. And at times over the history, one had outperformed the other in terms of total cumulative wealth by 40 percentage points. I mean, these are meaningful differences in performance. Investors are allocating to the put spread collar in order to get the protection benefits, in order to reap some benefits in terms of reducing peak to trough drawdowns. Well, there's considerable variation there as well. So over our sample, the S&P 500 experienced a peak to trough drawdown of about 50%, 52%. And then if we look across the three tranches, two of them saw peak to trough drawdowns of about 32 to 34%, and one saw a peak to trough drawdown of 25%. Again, considerable variation in outcome. And if you look at the spread portfolio, so if you just look at one tranche versus another, the tracking or the volatility of that spread portfolio is about 4% annualized, whereas the volatility of the strategy itself is only about 11%. So meaningful dispersion in outcomes just based off of nothing but when the strategy rebalances. These three tranches are essentially identical in every way, except for the fact that one happens to rebalance in December, one happens to rebalance in January, and one happens to rebalance in February. And I should add that the intent of the paper was not to be critical of the strategy. In fact, we never have a positive or negative thing to say about the strategy itself. Our intent is really just to characterize the impact of essentially an arbitrary decision, which is when is a strategy rebalanced. And I would argue that the fact that fund managers offer different tranches to their investors is, in a sense, an acknowledgement of the fact that they are different. If the three strategies were identical, if the three tranches were identical to each other, there'd be no reason to offer three different flavors of this. And the same could be said for other maturities as well.
Such an interesting point around the luck. And I'm looking at the quarterly rolls. So if I go back to last September, it turns out that literally is the low in the S&P last year. And not surprisingly, it's not the high in the VIX, but it did have a 32 VIX. Now, I know this collar is a 3-month collar, but a 32 VIX is going to tell us something about the market clearing price of 3-month vol as well. So if I just happen to get in on this put spread collar, I'm getting in at the lows, but I'm also selling vol, as you said. This is really a short vol trade. You're buying a put and selling a strangle. That's how I think about it. You got an additional leg that's short at close to 30 vol. So it's a significantly different pricing environment for the vol surface and leads to a higher call strike at the same time. So interesting. So what are the remedies? You talked a little bit about kind of multiple classes, but from an investor standpoint, the put spread collar is consistent with my risk preferences, but I don't want to get lucky or unlucky. What are some of the remedies for the observed timing luck that you guys have published on?
Let me just add one thing before remedies, and I want to talk about a root cause for this rebalance timing luck. So you mentioned one which was important, which is that the call strike that is self-financing at the time that the put spread collar depends upon market conditions. And the most important condition is volatility at the time of the rebalance. But skew matters, interest rates matter, dividends matter. It's just that interest rates and dividends tend to move more slowly between rebalance cycles versus volatility. So that volatility can change on a dime, and with it, the call strike that is issued with a put spread collar. So if you have a 2% call strike versus a 7% call strike, I mean, that's going to have potentially a big impact on the potential performance that the strategy would realize. But the other thing that matters is the delta profile of these options strategies. And similar to the put protection idea, options introduce delta, and here we have a collection of 3 options, which introduces a somewhat complex delta profile of the strategy relative to the index and relative to time. And what you can see is if you look on certain dates, depending on what transpired in markets, the delta of the three different tranches on the same date can be wildly different from each other. You can see one tranche with a delta of 0.1, another tranche with a delta of 0.9, and the third tranche with a delta of 0.45. And of course, three strategies that have a difference in delta of that magnitude are going to have potential for considerable variation or dispersion in performance. I think that takes us to the remedy. So for the remedy, I think I have to describe two different objectives when somebody is allocating to a strategy such as this. If someone has determined that the put spread collar provides an appropriate evergreen exposure for their portfolio, that this is intended to be a long-term or a very long-term allocation, then there is little reason to take this dispersion. It provides no value. The three strategies should, in theory, have the same expected return and the same expected drawdown and the same expected vol. Some are going to get lucky, some are going to get unlucky. And one way to reduce the impact of that luck is to diversify across them. That would be a natural remedy for those who are looking for evergreen exposure. But not everybody who would allocate to such a strategy is necessarily looking for an evergreen exposure. If someone is actually looking to protect their portfolio or to achieve a certain profile over well-defined dates, and this is where I think the idea aligns with the finding of the pathetic protection paper, but if you are specifically interested in having a profile that the put spread collar delivers over a quarter, let's say between December to end of March, then allocating to that specific tranche is the appropriate strategy for you because it provides exactly the profile you're looking for, whereas the average across three tranches does not. So I think it's important to understand someone's underlying objective when allocating to the strategy, and based off of that objective, you can determine an appropriate solution or remedy to some of these issues.
It's such an interesting topic because the results really are striking. And I just would encourage our listeners to take a look at the results because they're larger than you think. And as you said, you want to be compensated for uncertainty that you're taking on. And this is not something that you are compensated for. Well, Roni, let's move on to another piece of work and research that you've been responsible for, and that's on corporate bonds and this decomposition of the risk and return attributes of corporate bonds. Most of our listeners are familiar with the Merton model and this idea that the corporate bond spread is in some version a risk premium associated with volatility at the firm level. So that's some basis of what you're looking at here. But walk us through, number one, the motivation for this particular area of research for you, and then the key findings.
Yeah, so the motivation was, as I was involved in the options strategies and the volatility risk premium, and I was talking to a number of people just in the industry, one thing that really struck me was, and I think this is maybe behavioral to an extent, but that there is, in general, within the investing community, widespread comfort, just absolute comfort in investing in corporate bonds and discomfort in allocating to volatility risk premium. And when you talk to people about potentially putting on a volatility risk premium exposure, the concerns are about the left tail risk that we talked about, and you might hear expressions of picking up pennies in front of a steamroller. People might point to some of the big events that have happened. And of course, we saw more of that in COVID. But I was just struck by this difference in view of these two exposures that are actually quite similar to each other. And the Merton model is a theoretical foundation for that, where Merton showed that a corporate bond is economically equivalent to a government bond plus a short put option on the firm. So I wanted to explore that in a very carefully constructed performance attribution to do a full accounting of what is driving the returns of corporate bonds. And to that end, I looked at a number of corporate bond indices. I looked at high yield and investment grade across different maturities, 1 to 3 year, 3 to 5, 5 to 10, and 10 plus years. And the performance attribution included those exposures that I thought, were theoretically relevant to the performance of corporate bonds. So it started with duration matched government bonds. Again, this is just coming straight from Merton. And then I constructed two different portfolios next. One was a constituent-weighted equity portfolio. So this is where I would take a corporate bond index, find all the constituents in that index, find the weights of that index, and to the extent that the same companies had publicly listed equity shares, I would get those equity shares and build a constituent-weighted equity portfolio, and that would be one explanatory variable. Then I repeated the same exercise using single name options on those equities and built a short equity volatility risk premium. But again, this is single name, not index level volatility risk premium. And then I added another explanatory variable, which was short bond volatility. And the reason for this is because a number of corporate bonds are callable. And that callability feature should introduce a short bond volatility risk premium exposure. So I ran the analysis, and lo and behold, the exposures came out pretty much exactly as you would expect them to, which was comforting. And when you do the analysis at that level, just at that high level, what you find is that the alphas of that regression model to those four explanatory variables was statistically insignificant and around zero. But then you can go another layer deep, which is that there is a difference in volatility risk premium between single name options and equity index options. And idiosyncratic risk and systematic risk are correlated to each other. So if you look at this corporate bond index, it has exposure to systematic volatility. And systematic volatility is price. This is the volatility risk premium that we've been talking about. And when you go one layer deeper in this performance attribution, what you end up finding is that the alpha of corporate bonds is negative. And after you do the full accounting, you see that there are a number of factors or exposures within corporate bonds that provide risk, but don't provide return or provide negative return. And to me, that suggests that investing in corporate bonds is suboptimal relative to an alternative portfolio, where that alternative portfolio is choosing to allocate specifically to the risk premium that are positively compensated and excluding those risk premium that either are uncompensated or negatively compensated. And when I explore that in this paper, what I find is that it is possible to construct a portfolio that has similar exposure to the compensated risk premium, has higher returns because it's not loading either negatively on risk premia or positively on negative risk premium, and it has lower volatility because it's excluding those other exposures. So you end up with a material improvement in Sharpe ratio for this alternative portfolio.
As you decomposed the risk and return profile of the corporate bond, of course, the equity vol side is a prominent factor. The bond volatility side, I think, is underappreciated. And that's really interesting because if you go back to the COVID crash and then the cleanup, the rescue period afterwards, and that could kind of bring us into, let's call it 2021. And you had the promise from the Fed really of, we are going to be stuck in the lowest of low rates for an extended period of time. And so the market looks at that and says, okay, we believe you, and took the MOVE index, some proxy for interest rate implied volatility, into the 40s for most of late 2020 and into 2021. And I wonder if that was underestimated by the corporate bond buyer who said, look, this interest rate volatility component is unsustainably low. I'm certainly not being compensated for it. And as you said, the issuer is effectively getting long that vol through the ability to call the bond. And of course, we had just an incredible explosion of rate vol in late 2021 and into 2022. So that's a really interesting component. How much of the rate vol part of it figures into when you say it's not a good deal from an alpha standpoint? How much of it is the rate vol side?
Well, I mean, I show that the rate vol in this case is, so I do see a volatility risk premium in bond markets, which is consistent with what I mentioned when we talked about building the cross-asset class diversified volatility risk premium portfolio. We see exposure to it here. I'm not sure if it's possible to identify what's driving the negative alpha in the strategy. Is it an underappreciation of one component or another? But I do see exposure to bond convexity. And importantly, and this is where everything gets tied in a nice bow, but I took the corporate bond indices and then decomposed them into the component that has callable features and the component that does not, and looked at the risk contributions and the exposures of those decomposed indices. And thankfully, what you see is callable corporate bonds are short bond vol, whereas non-callable corporate bonds are not short bond vol. But the other thing I would just say about this, and this is similar but enhanced to other ideas that we've talked about, but a corporate bond is an incredibly complex instrument. It has a lot of exposures embedded within it. I mean, you're talking about exposure to bonds, exposure to equities, exposure to equity vol, exposure to bond vol. The equity vol provides exposure to idiosyncratic vol and systematic vol. And then all of those exposures are changing on a day-to-day basis. I think it's very hard, to fully understand the exposures that somebody's getting when they're allocating to corporate bonds. And that's perhaps one of the benefits of allocating to the underlying risk premium directly, is it gives you more control because you can isolate the risk premium that you want and choose how much you want to allocate to it. They're not tied hand in hand. And an example I would give in this case is a number of insurance companies, as an example, maybe pensions, are looking to very long duration corporate bonds as part of their LDI program. But the universe of these extended maturity corporate bonds is pretty limited. So if they want to have any type of diversified portfolio of corporate bonds, there's not too much they can do on this security selection side. Whereas if you isolate the exposure, you can really separate the duration from the credit risk by going to these other derivative markets that provide similar exposure. And that allows you to simultaneously target the duration you want with a credit exposure you want. And it just provides more control when building an underlying portfolio.
Well, you've given us a ton to think about. It's been great to review some of your research process. Roni, tell us about how you bring all this together at Endeavor. You're using technology, you've got a tax efficiency angle, but certainly I think a devotion to being in the lab and looking at things from a academic standpoint. How does it all come together for the clients of Endeavor?
Yeah, so as I mentioned when I first introduced myself on the podcast, Endeavor specializes in creating and managing highly customized lifestyle protected growth portfolios. And the idea here is that every individual or every family has a unique goal that they are trying to achieve with their portfolios. They have their own cash flow goals, they have their own growth objectives, and it is our belief that it is hard to optimize for those unique goals if everybody is being placed in a similar model portfolio or a similar commingled vehicle. And what we have done is we have developed the technology and infrastructure, and we have done the research in terms of how to effectively construct custom portfolios and scale such that we can deliver optimized portfolios for these unique goals. And when we're seeking to optimize these portfolios, really what we're thinking about primarily are two different dimensions. One is focused on helping our clients protect their future cash flow goals. And for that, essentially, we are implementing liability-driven investing style portfolios. We build custom bond ladders that are designed to immunize by duration matching their future cash flow goals. And we couple those custom bond portfolios with highly diversified growth portfolios. And those growth portfolios are allocating to equities and to bonds. On the equity side, we focus, again, very much on personalization. We've implemented personalized indexing, where we buy for each client in a separately managed account a custom equity portfolio with their own selection of factors such as value, momentum, quality, low volatility. With automated tax loss harvesting, it enables custom socially responsible investing, so they can build a custom factor portfolio that includes restrictions based off of their own unique values. And then it's multi-asset class, so it's diversified with bonds, where the bonds are borrowing from some of these ideas we just talked about in terms of building a synthetic corporate bond as an alternative to investment grade credit. So there are a number of elements that come together in building these custom portfolios. And an important element of all of this is that we have integrated financial planning and analysis with portfolio construction. So we have what we call the portfolio lab, where our clients can come in and define their plan. This would be initial investment, contributions over time, withdrawal goals over time. That plan helps us build the custom portfolio because it tells us about the cash flows that we need to immunize in our custom bond portfolio. But it also enables us to analyze these custom portfolios to see how well they deliver against the plan itself. So the entire process is fully integrated from planning to portfolio construction. And it is our belief that by doing so, it enables us to build portfolios that better satisfy their goals, but it also allows us to have analysis that more accurately reflects the properties of the portfolios.
Fantastic. Roni, really, really enjoyed this conversation, learning more about your work and also about how you're applying it. So really appreciate you being a guest on the podcast.
Thank you so much for having me on. It was a lot of fun to talk.
The views expressed here by Roni Israelov are not to be taken as investment advice, a recommendation to buy or sell any security or other asset in any jurisdiction, or an evaluation of the merits of investing in any specific security or other asset. Roni's comments are made for informational purposes only. They are based on certain assumptions and current market conditions, and they are subject to change without prior notice. You should consult with your own financial professionals and advisors before making any investment decision.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.